With spring home buying season approaching, housing experts continue to closely watch the economy, which continues to be buffeted by high inflation, steep interest rates, continued geopolitical uncertainty, and fears of a recession. According to experts, home sales will continue to decline through 2023, leaving household companies to navigate a jungle of uncertainty longer than previously expected. Even after COVID is over and people are able to return to their offices and get back to their money, why is this household housing market still under pressure? Well, let's find out in today's video. Make sure to watch this video till the end. So it's evident that the US housing market is going through a crucial period in 2023 with conflicting opinions about the future of the market. Since the housing market began experiencing a period of significant growth in recent years, record low mortgage rates and the high demand for homes have pushed home prices to a level never seen before. However, some experts have begun to sound the alarms that there may be a housing crash on the horizon in the US, with a number of people expressing their concern about this possibility. Experts say that everything has to do with inflation, and this time inflation is soaring and there are fears that a recession might be impending in the country. However, the majority of real estate professionals do not believe that the housing market is in a bubble or that it poses a threat to the faltering economy in any way. There's no doubt that the housing market was the cause of the worst financial crisis in recent memory. After shoddy mortgages crumbled, a nation was left with foreclosures, thousands of new houses remained empty, and millions of American households were suddenly underwater due to bad mortgages. Throughout the preceding century, the housing market was faced with considerable challenges, but with the exception of the Great Depression of 1929, none of them caused the decline in home values that we saw during the Great Recession of 2007. In addition, it's important to note that not all economic downturns lead to a slowdown in the real estate market. Despite the economic downturn, the home market and demand remained robust during the 2001 recession. Over the course of the past century, the housing market has faced a number of severe challenges. However, with the exception of 1929's Great Depression, none of these challenges have resulted in a decrease in house values comparable to the decline that occurred during the Great Recession of 2007. It is interesting to note that the recent housing market boom has parallels with the previous one, with skyrocketing prices, bidding wars, and an influx of investors. This time though, most real estate professionals agree that the housing market won't crash or trigger a recession, and are even optimistic that will actually help the recovery of the country in the long run. It's clear that the mortgage industry has taken action against loans that ballooned in size or were designed to cause borrowers to fail. A buyer is only eligible for a mortgage if they can prove that they have a consistent, verifiable income. Due to this, there are significantly fewer risks that during Great Recession of 2005 to 2007, the majority of bad mortgages have been eliminated, and lenders have stricter requirements for borrowers. The housing shortage is too severe, with too many people trying to buy and rent houses. The growth of home prices over the past year decelerated in 2022 as mortgage rates rose and housing affordability decreased. As long as mortgage rates remain high, home prices are predicted to decline. Nevertheless, experts don't anticipate widespread unemployment as in the Great Recession, and believe that any recession will be quite brief. Therefore, fewer homeowners will be unable to pay their mortgages, and those who are struggling may sell their homes for a profit. Many homeowners are backing off as mortgage interest rates rise into the 6+% range, or as close to 7% as possible. There are some who cannot qualify for mortgages large enough to finance the homes they desire, others who cannot afford the rising rates and prices, and still others who are awaiting and seeing whether a recession will take place. This is resulting in fewer properties selling, fewer bidding wars, and fewer bids over the asking price. Many house sellers have been forced to lower their asking prices. During a recession, mortgage rates are anticipated to decline, which should reintroduce buyers to the market who have not lost their jobs. This will increase home sales and benefit the economy in general. It is possible for the housing market to assist the nation in climbing out of recessions. Although the US housing market is experiencing changes in 2023, most real estate professionals do not believe it will crash or trigger a recession. To prevent a repeat of the Great Recession, the mortgage industry has taken steps to eliminate most bad mortgages. However, there is a severe housing shortage, and most Americans hope to avoid another 18 months of hardship. It is also worth noting that as a result of the reduction in housing affordability, the number of people applying for mortgages has decreased as well. You see, in the past few months, the demand for new and existing homes has dropped. Home builders are reducing the number of residential homes they build, and house prices have fallen from recent peaks. The Federal Reserve's efforts to control inflation have caused a significant decline in house price affordability. Throughout 2022, mortgage rates have steadily been rising, with the average rate on a 30-year mortgage standing at 6.36% in December, which is more than double the rate of 3.1% in December 2021. Based on the median home price and a 20% down payment, their typical monthly mortgage payment in the third quarter of 2021 was approximately 55% higher in the third quarter of 2022 compared to the third quarter of 2021. Due to this, the demand for real estate has plummeted, and home sales have plummeted as well. Moreover, it's expected that the housing market will continue to be impacted by affordability issues as mortgage rates have increased and reached 7% for the first time in 20 years in October, and are set to remain high compared to 2021. As the demand for housing has declined, the sales of homes have followed suit. As a result of falling sales, new home inventories have risen and now stand at 8.6 months of supply as of September. This has led home builders to become bearish on the market, both nationally and for all 4 reported regions. The NAHB Builders Confidence Index has dropped below 50. It is fair to say that the collapse in demand and sales is having an impact on home prices, which are down over 1% from summer peaks, according to a report by Moody's Analytics. In contrast, the lower end of the market has shown a more resilient growth pattern, barely declining from its peak over the summer, in contrast to a decline of 1.6% for the top third of the market since its peak, and it's expected that lower priced homes will outperform higher priced ones as a result of the underlying demand from young adults and their dearth of starter homes available on the market. COVID-19 affected consumer housing preferences. Because of historically low mortgage rates, buyers drove up house prices to record levels, leaving the market more than 25% overvalued. It's important to understand that a 7.5% decline is only a correction, not a crash. It's unlikely that house prices will crash as they did during the Great Recession. We expect that the FHFA purchase-only HPI will fall back to late 2021 levels in early 2025. According to recent estimates, there is a 1.5 million unit housing deficit given current household formations and vacancy rates. For sellers, this could mean a decrease in property value, while buyers may benefit from lower prices since they are more affordable. Nonetheless, buyers should remain cautious. In addition, they should ensure that they can comfortably afford their mortgage payments, so it may be necessary for home sellers to be patient or to price their houses lower than expected. In general, the decline in the housing market is not surprising given the rise in interest rates. This correction is needed for the housing market to return to sustainable levels. What do you guys feel about this? Tell us in the comments. And that's it for today. Make sure to give us a thumbs up and subscribe to the channel for more videos like this. Don't forget to press the bell icon to get notified when we upload a new video. We'll see you guys in the next one. Peace.